I was told I have to use the microphone. So on that, thank you, John. And again, John's here, in working with financial advisors, otherwise to come with product solutions, otherwise, and we'll talk about those. John and I will really be covering kind of some of those strategies, those solutions towards the end of the program. So again, welcome. The introduction as we went through with Kyle, John, and myself. And really what we're going to do is, again, for everybody that wasn't here at the last presentation, give this quick hit. Largest tax reform in 30 years, right? It happened. It affects big business, SCorps, right? The Apples, the Walmarts, the things we talked about last time. It affects small business, SCorps, LLCs, sole proprietorships, partnerships, right? If you fall into any of those categories. And it affects individuals, right? Which is all of you, whether you own a business or not. And so based on that aspect and everything else, it is something to be aware of. I was just talking to somebody in the back of the room. I'm giving a talk tomorrow at the Nightdale Chamber of Commerce, and they were saying, this is something that our members don't seem to really, it's not high on their radar right now. And, overall, a lot of people just got through tax season, right? Anybody fatigued on taxes a little bit, right? Post getting everything to their CPA or working on it themselves, everything else. And I think really a lot of people think, not you guys, but a lot of people think they just went through tax reform. When overall, they're going through tax reform right now, right? It is 2018 that all these changes happen, and so their surprises will come this time next year, right? And so the goal is to not be surprised. Well, let's look at how we can not be surprised, but also how we can take advantage of these changes and really look at some structures, some solutions, whether those are products, their strategies, their legal planning, their tax planning. Hopefully we can help you implement some of those to your benefit. And now I'll turn it over to Mr. Frizzell.
Hopefully this one's on. I'm not sure. All right. Hopefully everybody can hear me. Again, as Tom said, my name is Kyle Frizzell, and I'm also an attorney with NC Planning. And as he said, I'm going to discuss, just some of the overall changes. If you were with us for our last presentation, we just kind of touched on the changes that the new tax law, the changes that the new tax law brought. But Tom and John are going to dive into some strategies later on. So again, as Tom said, this was the largest tax reform in 30 years. And as the slide says, it impacts everybody, whether it's an individual, businesses, large or small, and estates. And we're not going to touch too much, thank you, on what changes there were with estate taxes and stuff, but just kind of overall, the estate tax it wasn't repealed, but it was essentially raised to a point where it doesn't apply to a whole host of people. I believe it's $11.18 million per individual can be passed tax-free outside of the estate tax. So, and in our last presentation, we also discussed winners and losers. One of the largest winners that we're going to talk about were pass-through entities, and Tom's going to touch on this QBI deduction, the 20%, a little bit later on, but pass-through entities were a huge winner under this tax reform. SCorps also with the reduction of the SCorp tax rate. And most individuals are going to see some tax cut in some form or fashion. Kind of as far as losers go, large families are one of the largest ones because of the repeal of the personal exemption and that sort of stuff. Again, in your folders, you should have gotten a handout, and I'm not going to go all the way through all of that, but those kind of just are some quick hits on the changes to the tax code. It's this handout, Tax Cuts and Jobs Act of 2017. It dives into the changes in the brackets and some of the more important changes that impact a large portion of people. So let's see if I can make this switch. Wrong way. All right. And so this just talks about our agenda tonight. It's not so much of an agenda as it covers a lot of the highlighted portions that we're going to talk about. Again, I'm going to walk through some of these changes on the personal side and a little bit on the business side, but then turn it over to Tom here in a little bit to talk about strategies and more of the business QBI deduction and that sort of stuff. So on the personal planning side, if you do look at your handout, it does go through the changes in the tax brackets. And as you can see, essentially the tax brackets, the brackets themselves were condensed and the rates were lowered generally. I'm trying to get organized up here. Struggling with the clicker. So again, handout page 1, it walks through the tax rates. And just an example of what the changes brought, if you were a married filing jointly taxpayer with taxable income of $200,000, in 2017 you were at the 28% rate. 2018 the overall rate is going to be 24%. But if you are a higher earner and you're married filing jointly with taxable income of say $405,000, you were in 2017 in a 33% tax bracket, and now you're subject to a 35% tax. Along with that, the personal exemption was one of the biggest things that was repealed. I believe it was $4,500 per individual or $4,050 per individual, and that's no longer in the tax code. So they tried to make up with that a little bit with changes to the standard deduction. And the standard deduction previously was around I have it somewhere, was previously $6,350 for single filers, $12,700 for joint filers. Now, in 2018, it's $12,000 per individual, $24,000 for a married couple. So again, the personal exemption was eliminated, but on the standard deduction side, you have to have a lot of itemized deductions just to raise you up to that level. So that's one of the things that they were saying is going to change tremendously, is the number of people who are going to switch from itemizing their tax returns to just taking the standard deduction. Another credit that they retained the child tax credit. I believe it was $1,000 per child. They've changed that to $2,000 per child. And they've also added this new non-child dependent tax credit. And this one is a $500 credit. Again, it's kind of trying to balance out the repeal of the personal exemption. The $500 credit, this one applies to like college students, children with disabilities, or even elderly parents. So if they are a dependent in your household, this non-child dependent tax credit can apply and save a little bit on the personal tax side. One of the other highlights that we wanted to touch on was changes to the college savings account. Really the biggest change there is that previously it was used to pay for qualified post-secondary education. You can now use it to pay for private, public, or religious elementary and secondary school, I believe up to $10,000 per year. So along with that, we've already been through that. That brings me to kind of the first tip, and it's just to keep an eye on your personal tax bracket, because those college savings accounts are great vehicles for saving on taxes. So it may make sense if you're close to the bracket line to move more money into a 529 account. And so, for example, if you're a married filing jointly taxpayer, taxable income at $170,000, you're in the 24% bracket. The 22% bracket ends at $165,000. So you could, in theory, deduct $5,000-ish by moving it over to the qualified or the 529 plan, moving you down a bracket and saving you even more on taxes. So that's those are some of the general highlights on the personal planning side. Kind of moving into the business planning side, again, one of the biggest winners under this tax reform were C corporations. Previously, the tax rate on C corporations was 35%. That's moved down to 21%. And kind of correlating with that, but also on the personal side, qualified dividends used to be taxed at a higher rate. They're now taxed subject to different brackets than the brackets on the front handout. now taxed at lower rates between 0 and 20%. A large majority of folks won't pay on qualified dividends. They may not pay any tax. They may pay 15%. And then for really high earners, they may pay 20%, and the 3.8% net investment tax may kick in at that higher level as well. As far as changes in meals and entertainment go, previously, both of those you were able to deduct up to 50% of that on the business side. The way that has changed is meals are still deductible up to 50%. It now encompasses the meals to employees. So you used to, in some cases, you could deduct the full amount to meals to your employees. Now that's subject to this 50% limitation, so that's actually kind of a loss. And entertainment, this is the side that really changed. It's not deductible at all. The deduction for entertainment expenses used to be 50%, and we've, again, under the new tax law, that's just gone away. And then the last bullet on this slide talks about changes in terms, and it says don't get surprised by these smaller changes. A few of those that we wanted to highlight were like-kind exchanges. For one thing, they still exist, but previously you could deduct or you could defer tax on personal property. You can no longer do that. Like-kind exchanges under the new tax law only applies to exchanges of real property. Also under the new tax law, this net operating loss, used to you could carry it back, I believe, for 2 years. Now it's limited to only a carry forward, and you can only carry forward up to 80% in a given year. So, for example, if you had a $100,000 operating loss in a given year, you could take $80,000 of that loss in the next year to reduce your taxable income, but you would still have $20,000 that you'd have to carry forward to another year. In years past, you could have amended your tax return from a previous year and taken that net operating loss in 2 previous years. So those are just some of the high-level changes. Again, the handout spells out more than what I have here on the slides. A couple that are, I'm sorry to jump around, but a couple that really stick out on the personal side are mortgage interest deduction. That's been reduced to you can only deduct up to the interest paid on up to $750,000 in mortgage debt. And one that catches a lot of folks is the home equity side. Used to, you could deduct interest paid on home equity loans. That's no longer the case. You can no longer deduct interest paid on a home equity line. In this state, it's not so much of a big deal, but the state and local income tax deduction that a lot of folks would itemize, that's been capped at $10,000. Tax preparation fees are no longer deductible on the personal side. We talked about the child tax credit, and one other thing that I just wanted to highlight was that the health insurance mandate requiring everybody to purchase health insurance has been repealed as well, starting of January of next year. So no requirement to, or no penalty for not having health insurance starting next year. I think those were most of my highlighted sections. So Tom, if you want to come talk about the fun QBI deduction, any questions on any of that? And again, the handout kind of covers a lot more than what I went through.
Thank you, Kyle.
Yep.
Thank you, sir. Yep. Yeah, so again, looking at the handouts that you guys have, looking at those material changes, one of the questions, again, that was asked, how much guidance is being released? Just one of the points that was mentioned that really came out as part of tax reform, like home equity lines. It came out and it said home equity lines are not going to be deductible any longer on mortgage interest, right? Well, now they've come out and they finally released this groundbreaking guidance on home equity lines that says, no, you still can, the IRS says, but it has to be for your home, right? So you can't use a home equity line, go buy a car, and deduct that interest you pay as mortgage interest, right? But you can if it's for improvements to the house, right? Or, kind of construction or anything else. So if it has to do with the house, you can still deduct it. Other guidance, not so much. The AICPA, right, the American Institute of CPAs, is asking the IRS for more guidance, right? The tax forms aren't out. So it's how does this apply, and none more so than this QBI deduction, which again, I'll go over it for those that weren't here last time. But one of the biggest impacts to business owners, right, small business owners, and a lot of them still, there's a lot of confusion of how it will apply. There's more of the, the great thinkers and just kind of the guidance of working it through post-rush, right? Because when this tax legislation was passed, it was passed quickly, and it was kind of pieced all together. And so a lot of it was guessing, really, in January of how things would be interpreted. And now some of that has kind of come to a more stable position. So we'll talk about that a little bit. But again, the guidance is slow to come out. The tax forms aren't necessarily out just as of yet. But there are significant material changes, which Kyle went over. Look to those handouts, even if it's just individual, non-business side. Those are things that your clients will want to know, you'll want to know from a filing perspective. So the qualified business income deduction, or the QBI deduction. We talked about this a good amount, last time, a couple months ago, but openly, in order to understand this, I just want to go through a scenario of how we come to our tax liability, right? So how many in here actually file their own taxes? Prep them and file them, not file them, but prep them and file them, right? Maybe about a third, right? So for those that do, maybe it's a surprise, or for those that don't, because if you do your own taxes, you probably go through a software. But essentially, you start with this total income amount, and then you have what they call above-the-line deductions, right? And you come up, and those are some that John's going to talk about, and some of these other aspects that are deductible off of your gross income number to basically work your way down to an adjustable, what is your adjusted income number, right? From your adjusted income number, then you're going to work your way down, and basically be able to take your itemized deductions in the past or standard deductions. Right? And once you do that, you get your exemptions, which have been eliminated, and then you get to your taxable income amount. So when we talk in this next piece about taxable income, I'm talking about your personal taxable income on your 1040. I think it's line 42 or line 43, right? So just know that it has nothing to do when we say taxable income with the business tax return, if that's separate, but essentially your personal individual side. So everything kind of goes to that when we talk about the QBI side. Once you get to taxable income, so you have your above-the-line adjustments, you get to taxable income, and then you have kind of the below-the-line adjustments, tax credits, and everything else to get to your final number. But again, having an understanding of how that functions or flows will help as we go through QBI. QBI essentially was put in place and is essentially qualified business income, which as a definition would be ordinary operating income, excluding interest income, capital gains, things you may get from investments, dividends, like if your business has that, loaned money out, got that back. And it also excludes owner's wages. So if you're an SCorp or an LLC and you pay yourself a guaranteed payment as an LLC, or W-2 salaried wages, right? Say you pay yourself $100,000 as wages for an S-corp, those will be excluded from your operating or from your qualified business income calculation, all right? So just know if your total income's $300,000, but you pay yourself $100,000, you're talking about $200,000 for the QBI total, right? But what the IRS has essentially said is once you come up with that QBI total, we'll give you a 20% deduction off of that. So, SCorp owner with a QBI of $100,000, that's 20% off or $20,000. I'd take $20,000, right? Anybody else, right? It's a big deduction, off of, again, the income. So what you would look at there is if the QBI is $100,000 and you're getting to remove $20,000 even before, right, you're kind of going through and really, calculating tax amounts, anything else as it flows through to you, it's a substantial savings. It can drop your personal income tax rates on your business income substantially. So again, a pretty good deduction if it can hit. Well, of course, nothing's ever that easy, right? We talked about this last time as far as the IRS giving us, limitations and otherwise. So what are those? Well, let's go through a couple examples and we'll talk about it. First is, let's take a married couple, taxable income of $200,000. Wife's an employee and receives W-2 wages. Husband's QBI is $100,000. Let's say he's an accountant, right? He's part of an accounting firm, sole proprietorship. His QBI deduction would be $20,000, right? Their total taxable income is $200,000. Now, let's talk about our first limitation, right? Our first one is, as long as your taxable income is less than $315,000, married filing jointly. Remember, that's that line 42, I think, taxable income on your 1040. As long as it's under $315,000, married filing jointly, you don't have to worry about anything on QBI, right? You'll get your 20% of your QBI, calculation. If it's over that, $315,000 married filing jointly, or $157,000 if you're single, if it's over that, these limitations will apply. So again, $315,000 in taxable income, right? That means your personal 1040 after you've gone through adjustments, and that could essentially throw, if you own 5 businesses and you're over $315,000, it's going to throw all 5 of those into these tests that we'll go through later, right? So taxable income, your individual taxable income, if I don't talk about it enough, is very, very important under this new tax reform. So again, essentially, the next limitation is personal service companies, right? So who are personal service companies? Essentially those that you would look at the asset of the company or the personal service provided as a key asset of the company. This would be health, meaning doctors, dentists, accountants. Somehow lawyers got thrown into those. Financial advisors, right? Investment advisors, brokers, consultants, right? Anybody that's really giving that type of advice or kind of key component. Again, a key area is looking for more guidance on who's really going to fall into this. Because, you may go see, a doctor because they're part of Duke Primary Care, but you're not going to see them because they're the principal asset of that practice, right? And the way the definition reads in the IRS, that's how it's looked at, is essentially, that they would be the key asset. So there's going to be some good tax court cases and hopefully some good guidance that comes from that or released voluntarily from the IRS on how these companies will be defined, right? But essentially, if you want to look at it, professional services businesses, who lucked out? Engineers and architects. They had better lobbyists than the rest of us, I guess. So they definitely lucked out from that. But if you are in those business, then you have to be very concerned about that 315 and the 315, 157 limits. If you hit those and you go over, you totally lose QBI once you go to 415. So if you're at over $415,000 in personal individual taxable income, you lose QBI totally for that business, for that professional business, right? So, if you're an accountant, you have an accounting firm, but you also have real estate, in LLCs that you rent out, you'd lose it for your, accounting firm, right? Just like our example here, if he was over, 415, but you'd keep it potentially for that real estate entity. So you'd still get it for one business, but you wouldn't get it for the other. See, IRS makes it easy, no problem. Yep. Good question. Principal asset is their brand, their reputation, right? So the way the IRS, and they actually pulled this definition from old tax legislation, right, and just threw it in there. Again, there was a lot of throw this in there, it seems like it works. So I would say yes, right? The way it's defined and the way it's kind of targeted is if the brand, right, is, you, right? But that's where I go back to, like, with healthcare, even though it's kind of used as an example. I mean, healthcare's changed a lot, right? They're branded, and again, hospitals own so many of the primary care physicians. You may have gone to that doctor for 20 years, but, they're an employee of Duke or Wake Med at this point. So are they really the principal asset, of that business? Yep.
Under the QBI thing, just a quick question here. So if you got an SCorp, there's a tax return filed there that's a flow through to the person. You're talking
Correct. Yep.
Whatever that number is, as long as the personal tax return is not over that 315, there should be a 20% on that income that's brought over.
Most definitely. So if you get a K-1, right, from your business, supposedly, we'll see, right? But it should show up on that K-1, right? Well, it'll come off the business income first, right? So, for example, on this next example, kind of probably a better relation of that, but it's attributable to the business side, right? And then as it flows through, as the business income flows through to your personal return, right? On this example, it's just going to be 20 grand less. Does that make sense? So, for our first example, instead of showing, 100,000, right, it would show 80,000 coming over onto your 1040. Mm-hmm. Does that help?
Yeah, I know that sometimes they do returns, they do the business one first, and they do the personal, so they won't know.
Yeah, that's interesting.
You're actually going to qualify until you do the personal.
That's interesting. I don't know. Neither do a lot of practitioners. And honestly, again, any other CPAs in the room? Okay, yeah, kind of put your hands down here, right? But I mean, as part of it is, I think a lot of CPAs who are tax preparers have focused so much on getting through, this tax prep season. And now as they dig out and get through extensions and everything else, they have to look at this. But a lot of it is that question mark, right? How will you know, right, if you qualify, and how will it flow through? But essentially, Kevin, maybe this next example is kind of a little more on point because it does deal with a fractional ownership where they would get a K-1. So again, limitations. Remember, we're talking about 315, right? That's a magic number if you're married, 157 if you're single, right? If you're under that, don't worry about any of these other limitations, right? Yeah. Mm-hmm.
315 is the number. Typically, so right now, I don't pay myself a salary.
Right. Mm-hmm.
So if I made, so if I made 415 total company to withdraw and then pay myself wages for 100,000,
Mm-hmm.
do I still get the full benefit from the 315?
Depends on your 1040 return. So are you married? Does your spouse work? So you actually have to take her income and add it in as well. Does that make sense? So it doesn't necessarily matter what your business has done, but it's a great question because, again, you can have whatever on the business income. What they're worried about is what shows up on your 1040, which is essentially a funnel, right? So if we're looking at, say you own 5 businesses, right, and you can make a couple $1 million in each, but this one loss, this one gain, everything else, and as it cycles down on your 1040, you're under 315. On your taxable income line 42, you're fine, right? That's right. If your businesses make money, right, and substantially and whatever else, then you're going to have issues, right? If you're in that, and again, if you're a personal service company, you really got screwed, under this deal, right? And we've got a lot of them as clients. And so, based on that that's the structure of how to look at those different elements and how to control taxable income, which I'll talk about in a little bit. There is definitely ways to kind of, have an impact on taxable income. If they did it on gross income and said, if you make over this, there'd be a lot less planning strategies to, at least consider, right? But there are some ways to essentially, make sure that you can stay in a window. If you're a very high income earner and you have personal service, you're probably going to lose it because you just can't get rid of that much income. But in other things, if you have other businesses, rental properties, non-personal service, those type of things you can. Did that help answer? Okay, so it's definitely, business side doesn't matter as much, individual. Another question?
I was just going to comment on that part. Like you said last time, if you have multiple businesses, you can set it up so some businesses you might qualify, some might not, and you can take advantage of the QBI each one.
Right.
On your personal,
Right.
by taking this.
And so let me walk through this example because this gives us our other test, right? And our other test was added late in the game, get the votes, everything else. But I really say this is kind of your real estate, investor, right? Your heavy capital company, investment. But essentially what it says is, if, and I'll kind of go through the definition, but again, the capital test. So when we talked about the first one and we talked about the, aspects of that 315, you then go to a next test is the W-2 wages test. That is, if you go over 315, so if we're over that 315, that magic number on our individual taxable income, then you can only take 50% of your W-2 wages that the company pays, excluding what you pay yourself, right? So, for example, if our married couple above, right, if their taxable income was $350,000, right, and our husband is just a sole proprietor, doesn't have any employees, only pays himself wages, what's his QBI deduction? 0. He lost it, right? Because it says basically if you go over that amount, right, and again, he's personal service, so that may be a different thing, but if you go over that amount, then you have to meet this 50% of W-2 wages test, right? If you're under 315, everything's golden. You go over it, you have to meet the 50% of wages test, and the other test is called our capital test, which essentially is an alternative, right? It says, hey, maybe you can't meet the 50% of W-2 wages, but can you meet this? The sum of 25% of your W-2 wages plus 2.5% of your unadjusted basis immediately after acquisition of qualified property. Real estate, capital property, things you can depreciate, right? Well, that 2.5% is pretty important, right? So think about landlords. Think about real estate investors, right? Buying commercial properties, doing development otherwise. And let's talk about this example. Married taxpayer with income exceeding $600,000. So they have a lot of taxable income. They're well over that 315 mark that we talked about. They own a 15% interest in real estate partnership which purchased commercial property for $10 million. No employees, no wages. Well, under the wage test, they fail. They would lose their QBI deduction, right? They just own real estate. However, under that capital test, we look at it from that framework. $500,000 of QBI, right? So that's what it earned, whether that's a good return on investment or not, times the 15%. That's the ownership percentage they have in the investment, is $75,000 of taxpayer income, right? W-2 limitation, 50%, 0 wages would be 0. So you essentially get no QBI. However, apply the capital test. 2.5% of 1.5 million, which is the 15 of the total, acquired costs, right? Because they own 15% of the deal, is 37.5, right? 20% of their income is 15, so they get the lesser of the two. They would get 15,000, right? So do you think real estate investors went out, or do you think, sole proprietorship service companies went out, right? Real estate investment, capital-intensive businesses definitely have this benefit, right? This was put in there where they don't have to employ people. They just have to deploy it in real estate, buildings, heavy capital, buy equipment, otherwise, because all this can come back to benefit them, even if they don't meet the W-2 wage test. So as a recap, just to try to explain, QBI, you get 20% of your business income, right, as a deduction. Everything's golden unless you hit 315. If you hit 315, right, you have to worry about your W-2 wage test, 50% of W-2 wages, and you have to look at this capital test, 2.5%, right, plus the 25% of wages, right? If you're a personal or professional service company, right, you lose everything at 415. So 315 is still a worry for you. You want to stay under there. But if you go over the 415, I think it's 415, 425, but if you go over that amount, then you lose everything. Other questions?
So Tom, does this take personal services pass-through type organizations that don't pay themselves salary?
Right.
And pay all the self-employed income for estimated taxes, et cetera, is it going to force them down a path where they're starting to pay themselves a salary so they can get this?
Right. Well, remember, salaries excluded. guaranteed payments are excluded, right? So if I'm an owner, right, of a LLC or anything else, and I've, taken that or an S-Corp and I haven't paid myself an adequate salary, it doesn't matter what I pay myself because that comes out of qualified business income up top, right? So, for example, qualified business income's $200,000, right? If I don't pay myself a salary, I get $200,000, right? If I pay myself a salary of $100,000, right, then $100,000 is going to come to me as W-2 wages, and the other $100,000 is going to come as profit, right? But the way the tax law reads, you only get the $100,000, right? It doesn't matter, right, for that. But it also doesn't matter for guaranteed payments. What's really interesting about this is LLCs that don't have guaranteed payments, and again, we're getting a little deep, but if you don't have guaranteed payments, which is how LLCs as partnerships pay compensation, they may benefit. But that's where the guidance is going to come out, right? Because if they don't have, if it's just kind of they pay profits, they don't pay salary otherwise, and this may be where your question is, they could benefit because, again, everything kind of comes to them as long as they stay under that 315 mark. Right?
Just think about the math in Schedule C. If you pay yourself a salary of 50, you have income that flows through to the 1040 of 200. What's the math to calculate the QBI given the, let's say, $50,000 salary you pay yourself that gets you to the 200,000 income that flows through to the 1040?
Good question. The biggest thing that they raised about this and why the AICPA is trying to seek guidance is the QBI doesn't fit anywhere on the tax return. It doesn't. They've had above the line and they've had below the line. And the best that everybody's explained is this is kind of in the middle, right? This is kind of in between the lines, right? Because if you look at the cycle and even Kevin's, point about kind of, what if you have, the business income and the personal income separate, right? How are we going to calculate this, right? The IRS has failed to release any guidance on that, right? That's the number one issue that the AICPA has written, numerous letters, formal requests, right, on behalf of the, profession to basically say we need guidance on this. And the scary part is everybody's living it, working it, owning the businesses right now to see how it is. All we can operate is off of the principles that, hey, we know these rules, right? But if we get into the minutia, we really don't know how it's going to calculate out, right? Yeah.
Question on the, like, if you got a client's got a lot of real estate properties, the LLCs on each income producing
Mhm.
property with the QBI, something I was reading that said was considered QBI rental income.
Most definitely. So like this right here, this second example, this could have all been rental income, right? Commercial property, whatever else, that $500,000 could be all rental income. So we talked about it more so last time and, kind of the winners. If you're a real estate investor, I would say you won under tax reform, right? Because there's depreciation, right? Accelerated depreciation. So you put things on your property, you invest in it, whatever else. You have more opportunity to have an accelerated depreciation or deduct that quicker. And then the other aspect is now you have this QBI deduction. So if you get rents in, right, then you're getting potentially the 20%, even if you don't have employees, because hopefully you'll still qualify under the 2.5, right? So if you bought a $500,000, piece of property and are renting it out, right, you'll get, based on those calculations, right, the rental income will do that. So again, from that side, real estate were big winners, and there's kind of, the history, or at least how this supposedly happened, was a senator who was very heavy into real estate who wouldn't vote for it if this wasn't in there. Yep.
Could you explain the W-2 limitation? I missed what you said.
Yeah, just 50% of W-2 wages, right?
Employees or yours?
Employees, so not including yours. Mhm.
Sounds like, I'm doing math right, instead of thinking my wife. So at some point, between that 315 and 425.
I think it's 415, yep.
315 and 415.
Yep.
There's actually a math equation that you're taking your wife's salary, your wife is working,
Mhm.
she could quit,
Right.
and it could
Correct. So, right, well, make sure you do that math, right, before you do that. But I mean, when this was being passed, there was a big question on, hey, everybody needs to be C-Corps now instead of S-Corps, right? And then they came out with this QBI, right? And then it was this whole thing, no, you probably still want to stay S-Corps, right? It's still probably the favorable. But I think I gave this analogy last time, if not in another talk, is, I know we've, from that aspect is, back in the day, you used to check the stock market every day. Now you need to check your taxable income every day, right? So, I mean, call your CPA up tomorrow, right? And have them run your taxable income for 2018, right, in May, and see where you're at. And say, my wife wants to know if she can quit working, right? Or if she should, because it's actually going to save us on taxes or otherwise, right? And of course, the old adage is, CPA will say, well, if you're making money, you're going to pay taxes, everything else. But again, this is substantial, right? And to game it every year is going to be challenging. But that's what we'll talk about, is not to really game year by year, but to implement some strategies that you can essentially use, kind of fund, drop your taxable income, kind of go from there. Yeah. It's pretty good, right? And so now, again, that's not just a credit that they're giving you, but to drop your income to that level, I forget, I may have said it again previously, but the tax rate, the applicable tax rate drop is huge, right? Because if you can save $80,000 before you pay taxes, right? And then, as Kyle went over, the tax rates are lower, right? And then if you really want to do the math, now where do I fall in the new tax brackets? Did I fall in one of those categories that collapsed and I'm a little bit higher? How do I get even lower, right? But I really do think, and this is one of the reasons why we probably jumped ahead, a couple months ago to do this. I think a lot of people, you watch the publicity that this is getting, not now, but year end and beginning of next year, right? And it may be not the publicity that a lot of tax preparers want. Yep. 15 or 20%, depending on your bracket, right? If you're in the highest bracket, it's 20%. Yep. So the interesting part on a C Corp is, it went from 35% to 21%. And C Corps are double taxation. And again, Kyle kind of hit on this. We talked about it more last time. But 35 to 21, and depending on if you're in the higher bracket or anything else, if you're in the highest, you pay 20 plus that 3.8%, kicker. You're still probably better off to be an S Corp based on, especially if you can get QBI deduction and everything else. Because under a C Corp, you're looking at still like 46%, 45% tax, right? But we'll talk about it in a minute. There may be some reasons to use the C Corp.
So, Tom, back to the 2.5% capital account question.
Mm-hmm.
Is that scientifically driven by the original cost, not an appreciated value of the original cost?
Correct. Immediately after acquisition, unadjusted. Yep. So let's talk about some strategies, some good things, right? We talked about, everybody kind of get an understanding. I wanted to go through that again, even for those that were here last time, to get an understanding of that QBI, because as much as we can, right? Still the specifics have to be worked out, but it does give us some rules to the game that we can play with, right? And so hopefully we can go forward until they release, additional and go from there. So let's talk about some planning strategies. And these will be quick hits, right? We'll talk about them. Happy to follow up. Great questions to sit down with your CPA, NC Planning, the attorneys that are here. We can definitely sit down with you. John's going to talk about some of these, so I won't steal, any of his content on, especially any of the plans, anything else. Financial advisors, CPA, attorneys should be actively communicating on tax planning this year and going forward, because you could do something on the financial side, right? That's going to generate more taxable income than what you want to for the tax saving side. The attorney could advise on a good legal structure, but that's not what you really want to do on the tax structure. So again, open communication. One of the things we always try to do is open it up, make sure the team is talking, right? Your advisory team. All right, so managing personal taxable income. Kind of an overall theme, right? Whether it's for you and your benefit, you don't even own a business, But for the business owners, the S-corps, the LLCs, the sole proprietorships, the partnerships, that taxable income we talked about, 315, right, is a magic number that you have to look at. 401ks, employer-sponsored retirement plans. John, you're going to talk about this a little bit, correct? So I won't take much of that thunder, but definitely consider those. How you use those, how you invest in those can drastically impact your taxable income. Accelerate taxes and other expenses. So here's what you get to, and this is no big secret. Again, a lot of times you'll call up the CPA in November, say, where am I looking at? Do I need to make an estimated payment? And the response will be, yeah, things are looking good. Why don't you go ahead and prepay this? Why don't you go ahead and pay your taxes? Anybody remember the news, end of last year where everybody was rushing to pay their property taxes, right? I mean, again, it was for the fear of that, there was a change, right, that some of that was it ended up being capped, and so people rushed to pay it. But from a business side, right, you could prepay, right? So anything that you want to go ahead and get out of the way, right, but it takes a knowledge of where am I sitting, right? Looking at taxable income and saying in October, hey, how am I looking so I can qualify for this QBI deduction, right? Well, it looks like you're going to be over. Well, I can prepay some of these expenses, right, and go forward from there. And so if you can do that, that may be something to kind of time out your, earnings per year to get you to the right place. Capital losses, if you're not talking to your investment advisor about, kind of tax loss harvesting on an annual basis, it's definitely something I'd look at. It's $3K against ordinary income for losses, but it's one of those things, especially when we look at charitable donations also. On a yearly basis, you want to be kind of looking at those if you have a good amount in investments and are trying to qualify for this taxable income piece. HSAs, health savings accounts, 401Hs, which are kind of similar. Again, health retirement kind of pre-tax accounts, and then charitable. We could talk a whole presentation about why, again, you should still consider charitable donations as part of your strategy based on legacy, charitable giving on an annual basis, great things we can do for estate tax and other planning. But in simple form, most everybody donates, property, right? You drop it off at Goodwill or some other charity, or you donate cash, right? So that's easy. Monitor those, because those can have an impact on your taxable income. And if you want to take something, you may want to give more this year than you would next year, right? So some of those things that'll come into place. A great way to do that is a donor advised fund. Again, I know there's some advisors in the room otherwise, but looking at a donor advised fund, which essentially is kind of like a simple charitable trust, right? That you can set up with an investment institution, but allows you to kind of fund a bunch in one year, but then kind of give it to the charity over time, right? So if you wanted to give some money to the church, but you don't want to have them have, $500,000 at once or $100,000 at once, you could put it in your donor advised fund, and that could take it out over time. Charitable trust, as I mentioned, something we do every day, looking at those from a retirement, a tax planning strategy, and a way to accomplish your charitable goals. But they also impact taxable income. So looking at those and making sure you at least consider those as opportunities. First and foremost, be charitably minded. We can talk tax strategies and why charitable needs to be considered, but definitely having a charity focus. Business income. So how to control, business income from that side. Capital asset purchases. If you look at those handouts, again, one of the material changes was greater accelerated, 179 other depreciation. So if you want to go out and buy something, this year is a good year to do it, right? I mean, don't do it just because you have money and you're going to get a tax break to do so, but capital asset purchases definitely is a way to do it. Real estate, right, if you're going to buy that and everything else, but looking at how that controls. So if you're in an equipment-heavy business and you say, well, I need to do this, or I've been leasing this, renting this equipment, well, this may be the year to do it. It may help you drop your business income, which in effect will help you on the taxable income side as well. Family employment. If you don't employ your kids, you may want to consider employing your kids, right? If they can't walk yet, you may want to wait until they can walk, right? But from that aspect it's definitely something to look at that. Yes, Kevin?
Is that 6,300, is that because of the child credit?
Right.
So I don't pay the tax?
Yep, you go over that and it kind of comes back to you and everything else.
What's the age of it?
I can't remember. I don't know offhand. 16, you said?
Is it 16 to
I don't know if it's 18 or 16. I'd have to look. But yeah, looking at, again, paying kids, it may not be a lot, but if they're there, middle school, high school, the qualifications for the IRS is make sure they have a job, an actual job, and a description and something that meets their talents, right? So if you say, well, I paid my kid $100,000 because they ran my marketing and everything else, and the IRS says, great, and you say, well, my kid's only in second grade, there may be a question mark there, right? If they're helping in the office, stacking papers, shredding, doing scanning, whatever else, totally different, story. Multi-entity strategies, we like these a lot because, of course, attorneys as liability protection, we're always going to look at, separating out business lines and everything else. But from a tax strategy, they're tremendous. And when we look at them, SCorps, right, which we brought up and everything else, especially today, but the really neat part about SCorps, well, two components. One, you can elect a different tax year than your typical calendar fiscal year end, right? So if we wanted to, we could set up a SCorp. Say we have 3 SCorps, right? All of those end in December, right? That's our tax year end for those SCorps. But we set up one SCorp and our tax year end is going to be September. That SCorp is management, marketing, and other aspects for those 3 other businesses, right? Those 3 other businesses pay that SCorp for management, marketing, other things. That SCorp also offers fringe benefits to the owners, long-term care, other things that SCorps can't do or can do but can't deduct it, right? And so what you're able to do, we were talking about timing taxable income, you can then in September look and say, hey, what's my year looking like? I need to prepay my contract with my SCorp that handles my marketing, my administrative aspects, my management, right? And so you can move some of the income over there. So it comes out as a deduction from your SCorps, goes into the SCorps. The SCorp has a September to September calendar year, right? So over the next 12 months, that can start to spend that down based on fringe benefits or deploying it for those type of services. But what it allows you to do is look at it at year end and say, how much do I want to prepay of this contract to my SCorp? Do I want to prepay 3 months? Do I want to prepay 6 months, right? And what it's allowing you to do is just control over all that business income and potentially taxable income, right? And then again, fringe benefits of SCorps are pretty neat. Personal service companies. So those of us that, aren't so happy, right? Focus on taxable income, know it, live it. Hopefully you're under that 415 or 315 mark, right? For those that aren't, it's to look at spinning out non-personal services. What does that mean? Well, in a lot of worlds, right, accountants. Accountants advise, but accountants also prepare taxes. But that's is that part of their core, their brand or otherwise, or could they spin that out and say, I have a tax prep side, and that's a separate company, and now I have a CPA firm accounting advising side. So the accounting CPA side, that's the brand, that's the personal professional service. The tax prep is just like a TurboTax or otherwise, right? That's an outsourced provider. And so now, if a lot of your income is attributable to that tax prep work, then potentially it's not under that personal service company. I can't wait for that tax court case, by the way, because it's coming, right? Somebody is going to take their business and split it up into about 20 others without talking to anybody, right? And they're going to do it on their own and think they're the smartest person, and it'll come out as a bad tax, court case. But I do think there's definitely credence to that. A lot of professional personal services have core service lines that really don't fit anymore with their personal. They've just done it that way, or that's the way they do it for convenience. So if you spin that out, then you may be over that 415, but you'd still get it for the tax prep side, right? So that tax prep business would still get a QBI deduction, even though the CPA firm, the advisory firm, may not, right? Does that make sense? Consider employment benefits, alternative investments. So again, John's going to touch on this a little bit on the retirement plan piece. Captive insurance, right? Anybody familiar with captive insurance? Have we mentioned it before? John is? Are you going to talk about it? Okay. No. Okay. But based on that captive insurance, the easiest way to think about it is kind of creating your own insurance company, right? If you're a professional, if you're a business owner, otherwise you pay probably a good amount of money in various types of insurance. If you're a high net worth income earner, right, what happened years ago is they created an exemption or kind of a difference for small insurance companies that basically said these small insurance companies, you don't have to pay income tax on the premiums you collect, only on the investment income that once they're in and the company kind of earns investments, puts it in the market, whatever else, you have to pay income on that. So let's break this down in a kind of an example. I'm a business owner. I have insurance for liability, other things, right? But I look at forming this captive, and essentially, just like our SCorp example, I decide to self-insure myself, right? So I put $500,000 into a captive insurance, right? That covers me on, brand, some other, cyber liability, some other things, down the line, right? So the captive actually is an insurance company. It's going to cover and pay if a claim arises. The hope is you have a good captive company that kind of guides you through that. But the benefit to that $500,000 is it was a deduction from my business. It goes over. The captive insurance company, which I also own, doesn't pay any tax on those premiums. What they will pay tax on is, say that captive earns 5% on the $500,000, right, over the next year. They'll pay tax on that 5%, but they don't pay tax on that $500,000, right? So it's a great way to, one, get it out, still control it. It's got some restrictions, but essentially fund it over there. Depending on how you set up those captive insurance companies, it can be a great structure for estate, for tax, for asset protection, for all these others. It's not a solution for everybody, but it's something we've been working with clients on a little bit lately. It works, and there's good companies out there that can help guide through it. And then from the legal tax structure, you can kind of look and see what works for you. Questions on these? One of the things that's come up a lot is, the personal itemized deductions. And again, examples would be, Kyle mentioned the mortgage limits, right? $750,000 or below. Property taxes, that was a huge element, year end. I got to run to pay my property tax, my sales tax, all of this, whatever income tax. I want North Carolina to have my money as fast as I can give it to them, right? Because now it's capped at $10,000, right? So the states are all scrambling to figure out how they're going to kind of address this. But just some quick hits. One, if you have a lot of real property taxes, right? So maybe you have a lot of real estate, but you haven't had them in an LLC. Well, now's the time to put them in an LLC, right? We would have advised you of that anyway for liability, for planning purposes, otherwise. But the property tax, that cap is personal. It's on the individual side. It's not for businesses. So you move it over to the LLC side and you should be good on that. Review classification and categories of expenses. If you put something in as client entertainment expense, right, then it's probably not going to be deductible. So if you put it in as marketing, you may have a chance on deductibility. But definitely review that based on Schedule A deductions as well. Home office. Employees used to be able to get a deduction based on their Schedule A, right, for home office setup, right? So if they were pure work from home, everything else, that's gone. You can't get it anymore. But how do you classify it, right? How do you kind of look at those? And watch your limits and plan accordingly, right? It'd be a shame for you to be surprised that, another $10,000, $20,000 you thought you were going to get to deduct of your check to North Carolina, you now can't deduct, right? So the moving between personal and business are a key strategy, and watching how you classify different things, in the books and kind of go through always is kind of a key element, because that's how the accountants or tax preparer or anything else is going to pull it and report it on your tax return. Questions on those? Yes, David.
On the same line of property taxes, if the business owns a rental property, the move is done on the state and personal, can they borrow against the equity of that property, business?
Mm-hmm.
Is the interest on that equity loan deductible, or is it on the same category as the personal?
So is the equity loan attributable to the LLC or to you, the individual? Meaning the LLC? Yeah, and most definitely. Interest deduction, right? Interest payments you have are still deductible.
Personal equity loan.
Right. If it's a personal equity line, you didn't use it for your house, you used it on a rental property, no, right? But again, that's guidance that's come out. First was, equity lines are not going to be deductible.
If you use the equity line to improve the property itself, that's in and of the state, that
Right, because again, business compared to personal, right? So that's separation and everything else. But again, a lot of business owners used to use home equity lines to do business startups, right? Go out there and find real estate, and if it was to flip the property or anything else, because that was, cheaper money, easy money to get, right? If you already had it, it was kind of just a line of credit that you could tap into. And now that at least wouldn't be deductible, right? Oh, shame. Home equity line is only deductible if it's for your home, right? Yeah.
So, splitting up the usual tasks relative to the 315. So if you had a business where you could find one that would be hired because of your name, the other half of that is just a service you provide that doesn't fully include your name. So take that as an even 50-50 split. So you're only, so now we'll look at, this comes in at full 20, 50% of the entity that is service. And then the other one is the remaining amount is what's estimated as 315.
Both have to be worried about the 315, right? Because once you go over 315, you've got your wages test and your capital test, right? But if you're a personal service, a professional service business, right? Once you go over 415, or as you go 315 to 415 above, you lose everything, right? If you move, like in my example, if you move 50% was your tax prep, right? And you move that over there under the premise that that's professional, right? That's over there and everything else. From that side, now you're over 415, but if you qualify based on the 50% of W-2 wages, you're still going to get a deduction for that, potentially, right? So the goal is to think, and again, it's going to be interesting to see kind of the creativity, and usually the tax court cases are, bad facts that the IRS can latch onto and know they can win. But it'll be interesting to see as those play out over years, or if we get some good guidance from the IRS of how that really should be defined, right? Because I think a lot of it is, if you look at, again, the professional or personal services overall, those have changed a lot over the last 10, 15, 20 years, right? I mean, we deal with a lot of, again, dentists and others. Some of them are solo dentists in the practice, and you know them. Some of them own 10 to 15 dental practices, right? They're not the personal brand within that. They've got them branded under a totally different element and everything else. So depending on how the language is kind of interpreted and comes out as guidance, you may be able to take it, well, this dentist over here who's, John Smith, DDS, and everybody knows John Smith, and he comes in, versus Triangle Dentistry, right? And John Smith owns Triangle Dentistry, but nobody knows John Smith, the dentist, right? Well, is that then equitable and fair, IRS? What have you done, right? And really it's not the IRS, it's, your elected officials. So does that help though? Okay. Other questions on that? If not, I'd like to turn over to John, and he's going to talk about some of that, the retirement planning aspects of that. Again, great way to control taxable income. Look at those strategies as you can benefit and kind of make sure you do hit some of these deductions.
Thanks, Tom. I'm going to take the last few minutes of the presentation tonight, talk a little bit about taxes and retirement planning and how that might tie in with QBI. Let's talk about retirement planning first. In general, when we're working with advisors, many times we'll see that their clients are accumulating money in qualified plans, be it 401k plans or profit-sharing plans, SEPs, simple plans, whatever it is they're investing in. And in many cases, we look at the projections and we see whether or not, 10 or 15 years down the line or whatever, whether or not they're really going to be in good shape to retire or not. And let me give you I wanted to give you an example here of kind of how highly compensated people are more or less, or there's kind of a reverse discrimination going on. If we have a $50,000 a year employee and they're putting 10% of their wages into a 401k plan, that's $5,000 a year. They did that for 22 years to age 67 at 6% interest. They'd have a pool of money sitting there for their retirement. That pool of money would kick off about $18,000 a year, give or take. In addition, they would have $20,000 or more dollars coming from Social Security, giving them a roughly $38,500 of retirement income when they retire. So the day after they retire, they're retiring on about 77% of their pre-retirement income, which isn't too bad. And I would say with most planners would say, yeah, you know, you're in pretty good shape. You should be able to live on that. But let's take a person making $250,000 a year. It could be a highly compensated exec. It could be a business owner. It could be a doctor. It could be somebody that owns their own business, an attorney, engineer, CPA, et cetera. So they're capped right now in a 401k plan at a contribution of $18,500 a year. And if that same person, that they didn't have any raises, and they kept putting in $18,500 a year, actually in this case this is $18,000, it's a little dated, they'd have a benefit at age 67 with all the same assumptions of about $65,000 a year. Well, if you had Social Security on for a higher income earner, they're going to get about $32,000 from Social Security, giving them about $97,000 of retirement income each year. But as a percentage of what they were making the day before they retired, that's only about 38 to 39%. So there's quite a gap there in terms of what, you know, how are they going to retire and how they're going to retire comfortably. Now, this is assuming they don't have other assets, or maybe they don't have a business to sell, or maybe they do have a business to sell. But if you know small business owners, they really don't know what their business is worth until they sell it. So they're counting on this as being a big part of the retirement, but they really don't know exactly what that amount's going to be. So it's kind of hard for a planner to sit down and incorporate that into the financial plan. Certainly you can make assumptions, but you really don't know. So we have this gap at retirement for highly compensated people, and obviously the more money you make, the more this affects those folks. So one of the ways we can plug that gap, so to speak, is through a different kind of qualified plan known as a cash balance plan, similar to a defined benefit plan. We all know defined benefit plans and cash balance plans are more or less like pension plans, which you all know or maybe have worked for companies that had pension plans. They're really going by the wayside in corporate America. But for small to medium-sized employers that have the right kind of employee group, right age, the right wage level, this can be very powerful, particularly when that individual is making $500,000, $600,000, $700,000 a year. With a cash balance plan, what you can do is put away large sums of money over and above your other qualified plans, be it your 401k or profit sharing plan. So we'll have employers who are good candidates for this, you know, particularly folks that are, say, 45 and older, really stash a lot of money away, which enables them to lower their income, and now in today's world, hopefully lower that income down to a point where now they take advantage of the QBI deduction. These plans became very popular a little over 10 years ago with the 2006 Pension Protection Act. Prior to that, there was a lot of gray areas in these plans, and a lot of employers were hesitant to get into these plans because a lot of there wasn't a lot of resolution about some of the issues. But the IRS did clear that up, and there's no legal uncertainty anymore. So if you set one up correctly and you do it with a pension administrator, and you have to use an administrator, it has to be done by someone who can take these numbers, look at your income, and then give you some kind of idea of how much you can put away, how much you can deduct. And this is something you do on an ongoing basis each year. So you set one of these plans up, and like I said, this is really geared to someone, say 45 and older, who's closer to retirement. If they have employees, hopefully it's not a large employee base. It's probably maybe 2 or 3 or 4 employees max that are more lowly compensated, and it can really work well. In your packet, you will see the last page, progressions of a retirement plan. And this is an actual case that we work with an advisor on in Florida with a couple doctors who, this is prior to QBI, but were paying a lot of money in income taxes and wanted to find ways to shelter. Oh, I'm sorry, is it not in your packet? I did see, should be probably the last page. It's a separate sheet. Is it in that package here? Okay, does everybody have it? Okay, so here we have 2 doctors, 57 and 48, each of them making $700,000 a year. They have 4 employees, 36, 29, 36, and 40. And mostly, you know, most of them are earning probably $50,000 or less. So if we look to the far left, we'll look at their current situation. They have a 401k profit sharing plan that Dr. Jones and Dr. Smith are able to put in $60,000 and $54,000 respectively. They do have a staff cost of $77.50, but if you look at the tax savings at the bottom, it's a nice tax break. But that's the max that they can put in under this plan. So they asked us, okay, what if, or they asked Heritage Administrative Services, who is one of our partners that does the administrative work, what would happen if we just equalize the amounts we put away, you know, for each other? So in that situation, Dr. Jones was now able to ratchet his deduction up to $145,000, Dr. Smith to $139,000, and they did have to raise their staff costs by about, you know, $3,000 or a little less. But it was well worth it to get the larger deduction for themselves. So now you can see their tax savings have gone up at a 35% tax bracket. But ultimately, they went for the maximum benefit they could possibly fund based on their ages, based on you know, their years to retirement. And Dr. Jones was able to get over $250,000 set aside, including the $60,000 he was doing in the profit sharing plan. Dr. Smith, $169,000, and now their staff costs went up about a little less than $1,000. Not a bad trade-off when we typically have employers who, you know, they like to do these things for themselves, but they don't always want to put a lot of money away for their employees. So in this case, we can show them, hey, you're already contributing to a plan now, and that gives you some offset. So your additional cost is minimal, but your total contribution is huge. And this can help them with, you know, kind of plugging that gap for retirement. Typically, you can accumulate close to about $2 million in a plan like this. A little more than that, the IRS says, and they ratchet that up with, they index it each year to spit out an annuitized income. And you can invest funds in, you know, traditional stocks, bonds, mutual funds, annuities, you know, whatever your advisor would think would be adequate. One other thing you can invest in is life insurance. So if you want to make life insurance an asset of the plan, you can put a life insurance policy in the plan, tax deduct your premium. It becomes an asset of the plan. And let's say that owner is putting money away for 2 years and dies. Well, the large death benefit from the life insurance can be a self-completing feature of the plan. So this death benefit is paid out inside the retirement plan. A large part of that can be tax-free to the beneficiary of the retirement plan, usually the spouse, and can help self-complete the funding of it. So that, in addition to cash value growth that adds an asset to the plan, will, go into the computation of what a client can put away. And in some cases, adding the life insurance can even ratchet up the deduction even higher. So it's a case-by-case basis. It's not always appropriate. But these plans, we're finding to be even more popular now with QBI as a way to substantially lower income, and do it on a very above board basis. You want to make sure you have a qualified administrator, one who knows what they're doing and can communicate with the employer each year. We definitely think, the CPA should be involved as well in that discussion. And, on an ongoing basis, these can be very powerful. So these plans can really help solve a lot of problems for highly compensated folks. Any questions?
On that cash balance plan, do you still have you got a client's got multiple companies, some have employees, some don't. Do you still have the testing in the cash balance plans, like 401k?
You can't just set up a plan in one business and not the others. You have to include all of them.
You said that like the 4 or 5 employees would be the ideal.
It would be, yeah, it would be if it's a traditional business, the fewer employees, the better, and the younger the employees, the better, and the less they make, the better. If you have some key people that are making, $150,000 and they're 55 years old, your contribution is going to be pretty heavy for those people. Because remember, this is a pension plan. You're required to put this money away to meet an obligation in the future. So, it may, unless they really like that person, or maybe they really want to do this to keep that person there, it could be kind of expensive. So these plans can be altered, and year by year, they'll look at the compensation of everybody. They will look at, how well the business is doing, what they can afford to put in. But, you got to have a business or maybe, like I said, a professional group where you have good, steady cash flow. Because, you take someone like a real estate agent who's self-employed, they might make a lot of money in one year and then not much in the following year, but yet they still have to fund the plan. We've run into those situations before, too. And it gets kind of messy because you've got to get the blessings of the IRS to decrease the contribution or do away with the plan. Any other questions? Okay, thank you very much.
Well, thank you, John. And again, looking at those, retirement plans, especially business, employer-sponsored retirement plans, if you're the employer, great way to control taxable income, save for retirement. John works with, financial advisors, so if that's not something your advisor's bringing up, right, maybe John can help on the education piece of that. But again, how many are a little overwhelmed with just thinking about how to approach this, right? I mean, here's a lot of information, right? And we could tell you and say, here's all different things that you could try, right? But sometimes the hardest thing is just to take that first step, right? So what I would tell you is this. Whoever you're most comfortable with, if you want to go talk to your CPA, they should have some, breathing room now post, filing. They still got to deal with extensions, everything else. But sit down and really go through this. And hopefully they've had time to go through and look at this analysis for how it's going to apply to their clients. Some of them probably haven't. They're planning to attend CEs and otherwise now that they can breathe. And that's okay. But it's to have that conversation, because if you are a business owner, you definitely want to be dealing with this now through the summer, not in November and December. It's going to be too late, right? And that's typically how things had functioned in the past, right? You waited and then you saw, oh geez, I need to buy some equipment, or I need to do this or whatever. And for that, it's going to be too late based on taxable income, the QBI, a lot of other things will just come as total surprises to you. If CPA is your trusted advisor, start there, right? Otherwise, we're happy to talk to you, right? Come talk to Lauren, Paul, Kyle, myself, Mike, anybody on the NC Planning Group, right? Our goal is to bring the team together anyways, but, to kind of walk through and just have that initial conversation, because this is our approach, right? It is not, hey, great, you attended this great tax planning, seminar. We're going to put all of this into place for you, right? And we're going to look at all of these strategies. Probably just pick one, maybe two, to kind of go through to see if it works, to see if it helps, right? And then you bring the team together to see, is it a retirement plan? Is it something else on a multi-entity setup that we can control with a retirement plan in a SCorp otherwise, and to kind of look at those strategies. And then over time, you can develop what works for you, but if you're overwhelmed, usually that stops people from making any moves. And then you're just going to, settle into what you're going to deal with on the tax side. You're not going to be happy with it, but if you don't know how much money you lost, right, you just know how much money you owe, which is kind of the case every year, right? The CPAs or your tax software tells you this is how much you owe. What they don't tell you usually is, hey, if you would have done things right, this is how much you could have saved, right? Usually that's the next CPA you go to, right? They tell you how the other one, did not do that right. So based on that, right, just start with somebody, right? Have that conversation, seek guidance, have somebody bring together the team. And I would say, the reason John is here working with financial advisors, working with CPAs, working with attorneys like us, everybody needs to be talking about this, right? So open communication, have that initial consult, and then again, don't let it sit. If you're finding, late summer and you're a business owner and you haven't addressed some of this, you don't know what your taxable income is looking for, it's going to be too late. Any final questions? Did we cover enough? Did we confuse everybody enough? But again, hopefully this took it to the next level, a little bit more in depth on QBI, but also some good solutions on the retirement plans, right? Those different things you could look at as other aspects as well. We're here. If you need us, we'll be here after, of course, this conference, and just feel free to email any of us, contact us, and go from there. We appreciate it. Appreciate you sitting through. I know this went a little bit longer than anticipated again, but thank you very much. You guys have a great evening.